I would be very careful and be accurate, that fixing climate change is the greatest commercial opportunity of our time, right? With so many heavyweight and smart investors, asset managers in this room, could you elaborate further to convince them that your argument or proposition is correct?
Sure. Well, the first thing is to recognize just the scale of what's required. And Hanneke Schmidt was making this point in a previous panel. She quoted a 100 trillion figure, which is, there's lots of different estimates, but it's a reasonable estimate of the incremental, and this is the key point. It's not repurposing energy investment. There has to be a lot of that, but that is the incremental amount of investment in the energy transition alone. Now, the energy transition is 3/4 of global emissions, so it's the majority of the issue. It's not all of the issue, though. But that's what's required. And to put that into context, that's about 2.5 percentage points additional investment of GDP, of global GDP. And that would bring investment to GDP globally back to the ratio it was at the turn of this millennium. Which, by the way, when you think about interest rates and where they're headed, if we're moving in that direction, even if we don't move all the way in that direction, we start to see the impact on equilibrium interest rates and the overall level of interest rates. So first thing is there's just a very, very large scale investment requirement. The second thing, and I think, Joe, I'll appeal, Joe Bay, to some of your comments earlier, which really understand the value creation, why it's smart to do this and how you go through your portfolio companies and you're building this out, because it will be a determinant of competitiveness of a company and of value. And that's without appealing to any risk management or social license issues. It's just about running companies better, particularly in an environment where climate policy, and we listen carefully to what's happening here, what's happening in the mainland, what's happening in the U.S., where climate policy is becoming more and more clear and more aggressive. Let me give you 3 things on that, and I'm going to finish with an anecdote, which is that Paris Agreement 7 years ago, the estimate of the IEA was that we were headed to 3.5 degrees global warming, okay, based on the policies of all the companies, or the countries at the time. Now the IEA just released their latest outlook, energy outlook, and their estimate is based on the policies of countries. We're headed to 2.5. Based on the commitments of countries, including 2030, 2060, and 2050 here, the mainland and Hong Kong, we're headed to 1.7. So part of the question is that gap between 2 and, so A, there's been a lot of movement, not enough, but a lot of movement. Is that gap between 2.5 and 1.7 going to be closed? You form a different view of different economies, but by the way, if you've got a credible climate policy, as Paul Chan was outlining, you're going to have a more competitive economy, you're going to see more investment come in, and you get that virtuous circle moving. And I said I'd finish with an anecdote, which, and I apologize for this, but well, I'm not going to apologize, I shouldn't apologize for it. I'm just ruthlessly market Brookfield here for a second. I'll just be upfront about it. But the point I wanted to make is that, 2 years ago, Brookfield had about 20 gigawatts of clean energy in operation and 20 gigawatts in the backlog, in the pipeline. Today, the pipeline's up fivefold, over 100 gigawatts. That is the power of Sweden, and that's globally. The transition fund, similar to what you guys are doing, KKR is doing, and Blackstone's doing a version, and others are doing it, it was a $15 billion fund raised, closed in the spring, and we've committed $8 billion of that already across clean energy, including nuclear, carbon capture, and storage technologies. And like many of us, and I think you're all having the same experience, which is the number of transactions we're looking at. I mean, it is an absolutely target-rich environment. So just the scale of this is enormous. And last point, again, I'm going to peel back to what Joe was saying, is that we think that as it becomes increasingly apparent on who's on track or who's converging to the track, crucial thing, that they're going to get a valuation premium. And so we're underwriting things on a cash-on-cash basis before you get the valuation premium, so we see it as well. So all that ties up together for this enormous opportunity. And again, to repeat what I think this room knows, but just to ram it home, and 50% of that opportunity is in Asia. And having a financial sector that's a center that's focused on that brings, it's a global good, but it means the financial sector is highly, highly competitive.
Mark, you were the chairman of the G20 Financial Stability Board, FSB, in 2011, 2018. During that period, many reforms were pushed and launched by the FSB, and this includes Basel III, resolution regime to address the too big to fail, and shadow banking, OTC derivative, LIBOR, to name a few. My question is, do you think the global financial system is now significantly more resilient than it was in 2007 and 2008? And if so, could it withstand the next financial crisis?
I mean, the first bit of the answer, and again, some of this came out in the first panel. Absolutely, the core of the system is much, much more resilient, and in many respects, we saw the shock of COVID. We're seeing the shock, the series of shocks we're having now. Core of the system strong, and it's part of the solution, not part of the problem. That's the good news, and the issue alongside it, though, is that, look, risk, you can reduce, I don't believe, sorry, back up. You can reduce the overall level of risk in the decision, in the system. It is not that all risk is pushed to different parts of the system, and you can reduce the overall quantum. That said, the nature of risks can change over time, and one of the risks that we have, and where risks are located, certainly does change. So what are the risks we have now? We have risks around liquidity. We have risks around collateral shortages, and these are occurring in an environment where not just volatility is going up now, but we have the prospect, or the possibility, I would say, that central banks have to do more, possibility we have more negative shocks, unexpected things happen, and these risks start to crystallize. So, so what? So what do we do about that? And I think if I can, and this is where, as no longer a central banker, no longer chair of the Financial Stability Board, I'm going to make life a little more difficult for those who are central bankers at the Financial Stability Board, which is to take a big step back, which is that we're moving from one regime to another, one that we lived in for a long time, which was low inflation, low volatility, low interest rates, relatively predictable, et cetera. It wasn't a great, again, James, I would appeal to you, it wasn't a great world, actually, but it was predictable, it had its advantages. And now, for these structural reasons, more than just the short-term issues, we're moving to higher interest rates, higher inflation, higher volatility around inflation, collateral shortages, and others. That transition is very difficult for the system as a whole, even with a rock-solid core of the system, which is what I believe we have. And I think that some adjustment to some of the regulations for system-wide purposes, I'll be specific, a leverage ratio that includes home country government bonds, at a time where liquidity is scarce and we need the core of the system to recycle liquidity is at this point counterproductive. And of course, we had the example in the US with the Dash for Cash where it was temporarily removed. We have this problem globally, and it's exacerbated by quantitative tightening by central banks. I'm not questioning the QT, but the reality is it is going to get very tight in a number of government bond markets, and we're not recycling the liquidity. So that's the first thing. I'd make a similar point around the liquidity coverage ratio and its interaction with central bank facilities. And then the last point is that those central bank facilities themselves, as we saw with the LDI situation in the UK, they don't always get liquidity to where it's needed, and they need to have broader counterparties, broader collateral, and be standing facilities, always on facilities during this period of time, which is going to take a few years. And I think, you know, what I'm saying is not easy to accomplish, but, you know, Peter, when you go back to Basel, when everyone gets together, is recognizing the bigger picture of the shift from here to there, and we need to make it as smooth as possible. It's going to be bumpy anyway, so we need to smooth it. And the only way to do that is to have a collective view on it.
Mark, you've just been described as a rock star in central banking, and I entirely agree with that. So I would like to ask two questions, personal questions, if you allow me. When you were the governor of Bank of Canada and then Bank of England, you were the #1 in this very big and prestigious public institution. Now that you have joined a private sector firm, Brookfield Asset Management, do you have problem in adjusting to the position of not being the boss of the organization? My first question. The second one, which I really want to know the answer.
I have a problem not being the boss of this conversation, let alone.
That's given, that's structural in nature. And my second question, and do you contemplate following the footsteps of your predecessor of FSB chair, our good friend Mario Draghi, to enter into politics in Canada?
Wow, okay. How to answer this? I'll try and answer them together. Look, I found it a pretty good rule in life to follow what Mario does. First point. Second point, I've also realized he's a very hard act to follow. And, you know, I think we should recognize not just his service as a central bank governor before at the Italian Treasury, but as Prime Minister of Italy, and the bigger contribution that he made. So I'll just leave it. I'll leave it at that on your second one. But to link to the first, look, there are many ways to serve, and part of my experience from before in the private sector, and well, David's not here. David Solomon's not here, but we used to work together. Worked at Goldman, and one of the things I took from there was, you know, financial institutions work well when you have a team, and you work. It's particularly, and I'm looking at you, Noel. You know, global financial institution, you may work with somebody on a transaction or something for a client once in your career because you're pulling people from, you know, the whole corners of the organization, but you have to have that culture that's there. First point. Second, as you know, because we were colleagues at the FSB, and all those reforms that were put in, Ashley as well, Ashley Alder's here, all those reforms put in place, that's a consensus. Like, unless you're listening to everybody and incorporating and learning and moving together, those reforms don't happen. And certainly you could make the agreement but not have them come back and be implemented. And so that teamwork experience, that building consensus, it's what we do at GFANZ with the financial institutions in developing on a voluntary basis the framework for the net zero transition in a way that gets capital to where it needs to go. And so, and that's, you know, that's the spirit at Brookfield as well. So, yeah, I do have a problem not being the boss, actually, but don't. This is good. Don't tell Bruce.
I thought your answer to my second question was a very obvious hint, right? To follow the footsteps of Mario Draghi. Well, that's very wise.
You're not.
I realize that we're slightly behind schedule, but I just observed dessert has just been served. So to give you some time to enjoy dessert, I think we have a little bit time to allow one or two questions from the floor. Would that be all right, Mark?
Can we get off the personal life? That would be...
I have no control over what questions the audience may ask. Okay, Anybody wishing to ask a question or two? Victor? Microphone, please. Victor Fung.
Thank you. I'm Victor Fung. Welcome all of you to Hong Kong. Norman, Mark, you guys gave a tremendous exchange. I just like to really ask a question of you, Mark, from your perspective as the UN Special Envoy on climate action. You know, we're really now experiencing a lot of disruption, as we all know, from the geopolitics, from inflation and so on around the world. And we in the real economy, in the world of supply chains that I work with on a daily basis, we're really seeing that actually in action in spades. You know, everything is focused on the geopolitical disruption and all the things that we have to deal with. One of the things that unfortunately I'm concerned about being pushed into the background in the midst of all this is our focus on ESG and in particular climate action in the long term. Now, I'm very heartened to hear comments this morning that from a financial world perspective, it's one step back and two steps forward. Now, what do you think from your perspective as the UN envoy and looking at so many things in the ground? Are you concerned about the impact long term on our focus on ESG because of what's happening around the world today?
Victor, very important question. I'm going to come out on this side of the optimists or on the positive side of this. I do think it's the right way to think about it, one step back, two steps forward, but they're happening at the same time. So we are ahead of the game right now than we were this time last year. Let me give a couple of points from a financial sector perspective to back that up. April of 2021, we formed GFANZ, 160 institutions, 60 trillion of collective balance sheet at that time. It's not surprising that many of those founding institutions are in this room, actually, because they're the types of forward-thinking committed to the long term. At Glasgow, so basically this time last year, 450 institutions, 130 trillion of collective balance sheet. As of today, 550 institutions, $150 trillion of collective balance sheet. So one of the few numbers in the financial sector, unfortunately, that have gone up. At least it's gone up for the right reason. So that's the first thing. The second, if we go back again to April of last year, there was not a single bank, not one in the world, that had an objective for net zero 2030 for their clients, for their financed emissions. Not one. Today there are 53. There'll be 60 by the time we get to Sharm el-Sheikh, by the time of Sharm el-Sheikh. And also for Sharm el-Sheikh, and different people, depending on when you join GFANZ, you had targets of when you have to come up with your implementation plans, et cetera. 160 are due. We have 250 with 90 in the process. So it's not just on schedule; it's ahead of schedule because people are moving at pace. And these are highly sophisticated institutions. And Rob, I look at you, and BlackRock. Like it's up through the board, it's through the strategy, it's running through all aspects of it, and it's there. Two other points. One is that what we need for the system. Actually, I'll make 3 points. What we need for the system is an approach that's consistent to net zero transition planning. So of a financial institution and what financial institutions expect from companies and how they can help companies move. And literally today, that approach is being released. It's 300 plus pages, but it shows the level of commitment. And that's, again, it's part of that consensus that comes across. Next point, and then I'll finish, which is that, of course, a lot of this is about accountability. And what will be up and running by this time next year is something called the Net Zero Data Public Utility. That is all the financed emissions of the members of GFANZ. So as they get it, it populates the database, their targets, and then over time, it'll be performance against targets, so you have a track record. And I think what that will show, and by the way, that's all the major data providers from Bloomberg, Refinitiv, Moody's is here, MSCI, S&P, Morningstar, I'll forget a few, but underpinned by the OECD, the IMF, and others in terms of support for that. What that will do, and this goes to my last point, is of course it will show relative performance of financial institutions. So it's you always, you have data, you look at banks in a region or banks versus asset managers, that kind of. But what it will really show, I think, is as valuable as that is, what I think is almost more valuable is in real time, it will show the gap between climate ambition, that 1.7 degree figure I referenced, and policies, and provide real-time feedback to governments who have to do more, because finance, in the end, this room knows it, finance is an enabler. It can make something possible. It can accelerate it once there is the will, but it will not dictate it. It won't force it. It enables it. What we need is, and this is a lot of what the dialogue is here about the symbiotic relationship between clear objectives, the policies that back it up, and then a net zero financial center effectively that makes sure it's financed.
One very last question, Lawrence, and hopefully short one and short answer.
Goes through email, I'm bound to be long-winded. I'm Lawrence Lee, I'm of the Financial Services Development Council. We have talked a lot about global finance investment, and I think we're at a summit. I have a question about leadership, and not just leadership in the excellent sense, but the leadership in the sense that you described in your book, values. Finance is not just about markets, and we can't take markets for granted. I think those are your words. It's got to be relevant to the many. And we haven't talked about that as much today, other than in some conceptual way about ESG, so on and so forth. Could I take the cue from Norman's second question, which you didn't entirely answer directly, and ask, as a financial leader, how are you going to make what we all do here relevant to the whole community and not just our fellow financiers?
Yeah. Well, Lawrence, it's a great question. I think so there's two points I'll make. One is that, and to go to the value point, which is that there's a general desire of people that's welled up to have a more sustainable, or not a more sustainable, but a sustainable economy, to address climate change. And the issue has been to translate that into something that's clear and actionable, and it's the one bit of ESG where there are hard numbers and the brutal logic of the carbon budget and climate physics. Unfortunately, we're more and more expert in that, and so you can translate an overall objective of sustainability into how well we're doing on it, pathways, who's part of the solution, who's part of the problem, and map that into value in the market, and we see the power of markets as a consequence of that. And of course, that doesn't mean biodiversity, it doesn't mean just transition, doesn't mean a series of other things that people rightly want. But it gives the power, and that's part of the reason I think why things have moved so rapidly in the last few years. So we can show that we're moving towards what people want. I think the challenge that isn't fully addressed is how to give people more agency in making those decisions. In other words, with their own savings, however large or small, who they take insurance from, that there's clarity about which institution and which product is on track or part of the solution versus not. And there's, interestingly enough, and I should finish because we need to be short, some of the answer goes to fintech and some of the greater clarity that can come and translate it in a way that people can, to use the phrase in the UK, make their money matter. Right.
Thank you, Mark. I think running out of time, I think I must bring this session to a close. May I ask you to join me in giving a big hand to Mark Carney for his sharing. Thank you, Mark.
And ladies and gentlemen, before Mark Carney and Norman Chan leave the stage, gentlemen, I think we're going to have to get a photo of you before you go. Absolutely, we couldn't miss out on that. And I think the people in the audience will probably agree with me that I started, with we are going to give lie to the idea that central bankers are boring. I think what we established here today is that ex-central bankers definitely are not boring. Ladies and gentlemen, one more time for Mr. Carney and Mr. Chan. It's been a really fantastic day, and I have to give full credit to the Hong Kong Monetary Authority for putting together such a great event. Right from our opening comments, we had the chief executive here. We heard from the top financial regulators in China. ESG, sustainable finance, truly the titans of the industry were out to provide their experience and their views to help us move along. As we chart forward, the theme is navigating beyond uncertainty, and I don't think, a lot of the questions today were how much volatility do we expect? Probably a lot more to come. I don't think that's going to be less, but I think that we are all going to be better prepared for it after participating in today's event. And with that, I would like to welcome to close the proceedings the Chief Executive of the Hong Kong Monetary Authority, Mr. Eddie Yu. Please.
I will be very brief. I just want to thank all our speakers for sharing their insights today, and also again to all of you for coming here despite the weather. And I personally have benefited a lot from the insights and thoughts from the panels, and I've got a lot of takeaways, and I hope you do as well. And for all the visiting friends, I hope that you can take advantage of your time here. In the afternoon, despite maybe typhoon number 8, just spend a bit more time with your teams, reconnect with the community here, and also, if you've got time, explore the city and have a good time here. And before I close today's session, I just want to answer one question that I was repeatedly asked in the last 2 days, which is, will this summit be the only one, or are we going to expect something similar next year? We've been pondering. We don't know whether it's a yes or no answer, but there's another factor in play. Next year marks the 30th anniversary of the HKMA. So that gives us a very good reason to do it again next year. So I'll see you all same time next year in Hong Kong. Thank you very much.
This is great news. Thank you very much, Eddie Yu. Thank you to all of you for coming and for getting the insights that we need. We have been navigating through uncertainty, and in the words of Buzz Lightyear, and beyond. I'm Andrew Work. It has been my honor. Thank you. Go forth and prosper. Thank you.